President Trump's brand new One Big Beautiful Bill promises to reopen the health savings account door for working seniors, potentially doubling what can be stashed away each year, and even widen the list of things we can spend money on, including gym memberships. Before we dive into the fine print, here's a 30-second refresher on why HSAs are the unicorn of the tax code. Money goes in tax-free, grows tax-deferred, and comes out tax-free for qualified medical expenses, earning it the coveted triple tax advantage label. For 2025, the IRS lets you stash up to $4,300 if you're doing self-only coverage, or $8,550 for family coverage. And if you're 55 or older, you can tack on an additional $1,000 as a catch-up deposit. To see why this matters, pretend Maria, she's age 66, had been maxing out her HSA since age 45, earning a conservative 5% annual return. By the time she hits 65, her balance would land near $185,000. If the new bill lets her keep contributing at the regular limit plus the $1,000 catch-up for just 4 more years, her nest egg jumps to roughly $245,000. That's an extra $60,000 that will never face federal or state income tax. That sum is meaningful when Fidelity pegs the average retired couple's lifetime healthcare bill at about $165,000 for a 65-year-old retiree. Trump's One Big Beautiful Bill, passed by the House as H.R. 1 on May 22nd of 2025, is stuffed with tax goodies, but the sleeper hit is the HSA section buried in Subtitle B. The Joint Committee on Taxation pegs the HSA tweaks at roughly $44 billion in lost revenue over 10 years. That's no small line item. Supporters say it hands more control to patients and could lighten the eventual load on Medicare. Critics fire back that the benefits flow disproportionately to high earners who need the break the least. So what exactly changes? Let's start with who can contribute. Under today's rules, the instant you enroll in any part of Medicare, you lose the right to fund an HSA, even if you keep working full-time. The new bill in its current state nukes that roadblock. As long as you remain on a qualifying high-deductible plan through your employer, you could keep funneling dollars into your HSA past age 65, 70, or even 75 if you're still punching the clock. That single tweak carries a 10-year price tag of about $6 billion because roughly 5 million seniors are still in the labor force, and many of them want one more tax shelter. Next, let's talk about insurance design. Bronze tier and catastrophic plans on the Affordable Care Act exchanges have sky-high deductibles, but a quirk in the statute has kept them from being labeled as HSA qualified. Section 110.206 fixes that. If you're a freelancer in a marketplace bronze plan or a 20-something carrying catastrophic coverage while you build your business, the door to an HSA is about to swing wide open. This new bill also rides to the rescue of direct primary care fans and employees who use on-site or near-site employer clinics. Under current law, that kind of first dollar care counts as other coverage and can blow up your eligibility. The bill declares no harm, no foul. You'll be able to keep the convenience of walk-in wellness visits without sacrificing tax savings. Now grab your calculator because the contribution math gets a little spicy. The headline move sits in section 110.213. An income-based booster shot. If your adjusted gross income comes in below $75,000 for single or $150,000 as a joint, you can pour an extra $4,300 on top of the standard limit for self-only coverage, or a whopping $8,500 or $8,550 extra if you are in a family plan. The added headroom phases out completely at $100,000 and $200,000 respectively, meaning the biggest lift lands squarely on the middle-income households. Kiplinger notes that a qualifying family in that income band could suddenly sock away north of $17,000 a year pre-tax. Couples in their late 50s get another sweetener. Today, if both spouses are 55 or older, each must open a separate HSA just to make their individual $1,000 catch-up contributions. Section 110.209 in the new bill tears up that administrative headache and lets both catch-ups flow into one family HSA. It's simpler tracking, lower fees, and a higher balance that enjoys compounding interest in a single pot. The new bill also tackles the pile of cash sitting in flexible spending accounts and health reimbursement arrangements. For 1 year after enactment, employees who move to a high deductible plan can roll over up to $3,300, equal to the annual FSA contribution cap for 2025. They can roll that right into their HSA. Nationwide, about 8 million workers end the year with unused flexible spending dollars that would otherwise expire. If even half of that money shifts into HSAs, that's billions rescued from the use it or lose it graveyard. And what if your spouse insists on keeping an FSA at work? Well, under current law, their account disqualifies the entire household from HSA contributions, even if you're the one enrolled in the high deductible plan. Section 110.212 in the new bill kills that quirk, clearing the path for household HSA eligibility even when one partner sticks with a flexible spending account. Let's move from saving to spending. First up is the timing. The new bill allows you to reimburse medical costs incurred up to 60 days before you actually open your HSA, solving the age-old problem of the urgent care visit that lands right before the bank finishes your paperwork. Then comes the crowd pleaser, well, for most people, I think. Fitness. Well, Section 110.208 in the new bill would classify gym memberships, exercise classes, personal training sessions, and even some sport league fees as qualified sports and fitness expenses. The reimbursement cap starts at $500 per year for individuals, $1,000 for families, and ticks up with inflation. Imagine paying for your CrossFit or yoga studio with pre-tax dollars. That's the sort of perk that might finally motivate somebody to both save and sweat. Although most people will probably just keep paying for their membership, but at least now it's pre-tax dollars. A quick note though, the bill explicitly bars double dipping. If your employer already subsidizes your gym membership under a wellness program, you can't turn around and pay the same fee with your HSA. Still, wellness advocates say pulling exercise into the definition of health care is a game changer for preventative medicine. And logical, and I'm not sure why it took this long to get there. Of course, every tax break has a price tag. There's a $44 billion estimate that assumes only moderate uptake. But if participation rises faster, the cost could spiral. The Nonpartisan Committee for Responsible Federal Budget warns that expanding HSAs without offsets could increase the deficit at a time when interest payments already claim a record share of federal revenues. Brookings economists add that more than 70% of current HSA contributions come from households earning over $100,000, suggesting the bill might do little for lower income families. The legislative road ahead is equally important. The House bundled the provisions into H.R. 1 on May 22nd. The Senate Finance Committee is penciled in for a markup the week after July 4th recess. And insiders say the fitness perk and that income-based contribution bump are the two features most likely to get trimmed just to appease the deficit hawks. Even if the Senate passes a modified version, the two chambers must hammer out the differences in conference before a final package hits the president's desk. So what should you do right now? Well, step one is audit your current coverage. Are you in the bronze exchange plan? Are you enrolled in a direct primary care or approaching Medicare age while still working? Any of those scenarios could unlock HSA eligibility or extend it under the bill. Step two is to model your 2026 budget. Calculate how much extra you could shelter if the new caps survive. Step three is to gather your receipts, keep documentation for any gym memberships or personal training packages or early year medical expenses. You may soon be able to reimburse them with the pre-tax dollars. Policy changes come and go, but the core strategy stays the same. Maximize the tax advantages you're eligible for, invest the balance for growth, and use the account as a stealth retirement vehicle. Drop a comment down below. Would these changes push you to finally max out an HSA? And if you found value here, hit that like button, maybe subscribe to the channel, and share the video with a friend who loves a good tax hack. Thanks for watching. We'll see you next time, and enjoy the day.